Welcome to Options Education Series, Course 2, Strategies. The topic of this video is the option strategy known as the collar. Suppose you own 100 shares of stock that has recently experienced substantial gains. You wish to implement a protective option strategy that will let you sleep easy at night. The solution is the collar. The collar is also known as the hedge wrapper. To create a protective collar around 100 shares of stock, do the following. Sell one out of the money call option, also known as a covered call, and use the proceeds from the sale of the call, meaning the premium collected, to purchase one out of the money put with the same expiration date. Here's a screenshot of my trade architect. That's what I'm using. Notice that I chose the collar as the strategy. I also decided to pick November 18th, 2016 as my expiration date. Why? I'd like to protect my position through the next earnings report in October and also through the presidential election. The stock is currently trading at $112.71. The collar strategy consists of buying 100 shares of stock to start with, which you don't have to do if you already own 100 shares. So don't do it in this particular case. What I'm going to do though is I'm going to sell to open one out of the money call. In this case, I chose the $115 strike. I'm going to use the premium from the sale of this call to finance the purchase of a put. So buy to open one put contract, an out of the money put contract that has a strike of 110. Notice that the current price of the stock is right in the middle of the range, the $110 to $115 range. This collar, to implement it, it's costing me 20 cents a share. And since a contract gives you control over 100 shares of stock, 20 cents times 100, that's a $20 cost to implement the collar. In some cases, if the premium collected from the sale of the call is slightly higher than the premium paid to buy the put, you actually end up with a net credit. Now, whether it's a net credit or a net debit, that's largely irrelevant. What's relevant, though, is to learn how this collar strategy works to protect your investment. We already know that you have to own 100 shares of stock, and against those 100 shares, you have to sell one out of the money call contract, use the premium from that sale to buy one out of the money put contract. In effect, it's like free insurance. You're using the proceeds from the sale of the call to finance the purchase of the put. So let's find out what would happen to your overall position on November 18th if the stock were to drop or rise. Scenario 1 will assume Apple drops to $110 a share on expiration day. So here's November 18th. The shares are down by $271. Because remember, on the day that we implemented the strategy, the stock was trading at $112.71. Now, November 18th, what else happens? The call expires out of the money. And so does the put, because its strike price is also 110. So it expires worthless. Let's do the math as far as the profit and loss. Shares are down by $271. The put and the call are worthless. All in all, you're down $291. No, wait a second, you might say. You're scratching your head. Where is the protection that I was promised? I paid $20 thinking that I'm going to be protected, but no, I'm down $271 on my position, not to mention the $20 that I paid out of my pocket to implement the collar strategy. Well, just like with your auto insurance policy, there is a deductible. Your insurance here does not kick in until the stock drops below the put strike of $110. Remember, the put is a contract that gives you the right to sell your 100 shares of stock for $110 a share, no matter how low the stock falls. So the initial drop from $112.71 down to $110 is on you. If that's the case, then let's find out what would happen if the stock were to drop to $110 a share by expiration, meaning November 18th. So scenario 2, Apple drops to $100 a share. Your shares are now $1,271 in the hole. So its expiration day, the call is worthless. It's $20 out of the money. The put, however, is $10 in the money. It's got a strike of $110 and the shares are trading at 100. So $10 times 100 equals $1,000. So the math is easy to do here. The shares are down by $1,271. But the put that you bought is up by $1,000. It made up for it. So all in all, you're down again $291. Again, what is that? The deductible. So conclusion, no matter how low the shares fall, your risk is always limited to the deductible, $291. On the other hand, what if Apple were to rally instead? Okay, so we're about to find out now that you can't have your cake and eat it too. We already know that the collar is a limited risk option strategy. The next scenarios are going to demonstrate that the same collar is also a limited reward options strategy. Let's find out what would happen if the stock were to rally to $120 a share. So scenario 3, Apple is up to $120 a share. Your 100 shares now are $729 winner. Okay? The call, which has a strike of $120, is at the money on expiration. It's worthless. The $110 put that you bought is also worthless. So let's work out the math. Profit and loss. Shares are up by $729. And both the call and the put are worthless. $20 out of your pocket. That's always going to be the case. That's what you paid initially to implement the collar. So it's a drop in the bucket compared to the $729 profit that you just realized. So all in all, you have realized a profit of $709. I have news for you. No matter how high the stock rallies from here, your reward is going to be capped at $709. And let's demonstrate that. Okay, scenario 4, Apple is assumed to have rallied up to $140 a share. Your 100 shares are up by $2,729. But don't get too excited because you sold a call that has a strike of $120. And this call is now $20 in the money. It's going to be exercised, and your 100 shares are going to be called away. You're going to be obligated to surrender them for a price of $120 a share. So you see, no matter how far Apple rallies, $140, $150, $170, $180 a share, it doesn't matter. You're always going to be obligated to sell them for $120 a share. And the put, of course, is out of the money. It's worthless. Profit and loss, let's do the math again. The shares, as far as you're concerned, the only thing you're going to realize from them as far as profit is $729. The call and put, those are a wash, $20 out of your pocket. Make a long story short, profit and loss will always be capped at $709. So, in conclusion, the collar strategy is a limited risk, limited reward option strategy. That's how pros make their money. They keep their risk limited and the reward also limited. Now, let's discuss the profit and loss graph associated with this collar strategy that we implemented. A profit and loss graph, also known as a payoff diagram, is a visual representation of the risk-reward potential of a particular strategy. Every option strategy can be represented by a payoff diagram. And what you're seeing here is what you would be expecting to happen at expiration, the worst and the best outcome. As a reminder, the day we implemented the strategy, the stock was trading at 112.71. We already owned 100 shares of stock. What we did is we sold one call that has a strike of $120, and we charged a premium of $315 for that one contract. We then used this premium to buy us one put contract that has a strike of 110. We paid $335 for it. So the difference was out of our pocket, $20. Now I'm looking at the risk-reward characteristics of this collar from the point of view that the stock was trading at $112.71 on the day I implemented the strategy. So this payoff calculator is telling me that my max reward is $709. My max risk is $291. And those aren't numbers I came up with. That's what the calculator is telling me. Now look at this. Beautiful risk-reward proposition. Sure, the stock could have gone up to $240 and I missed out. Okay, I missed out. I didn't capitalize on the last $20, but that's all in hindsight. The stock could have fallen $20. What I did though is, after a substantial run-up, I implemented a strategy that guaranteed me protection against any downside. I'd like to wrap it up with a discussion about timing your entry. When using an option strategy, and this goes for any options strategy, and for whatever given purpose, the time factor is always an important consideration. So by using technical analysis, you can go a long way towards timing your options strategy implementation, oftentimes to near perfection. In the chart that I'm going to show you, and this is an actual example dating back to mid-August, Apple is shown to have reached a significant technical milestone on the heels of a substantial run. Now, you've been long 1,000 shares of stock since it was trading at $101. As a result, you've been rewarded handsomely. But now the technical evidence indicates a potential pause, maybe even an outright reversal. The three pieces of evidence collected on the chart that I'm about to show you are these. First, we have a gap fill right here at that upper black line. And we have an exhaustion signal at the mark 9139 sell signal. The W pattern was identified as a bearish bat harmonic having a target of 109.58. So we got to that level. And the AB and CD leg relate to each other via the Fibonacci 1.618 extension. This is enough for you to want to consider the collar strategy as a means to protect your gains. Who knows, through the next earnings release, maybe in October, maybe even beyond that, until the presidential election is over. So with the stock currently trading near $110 a share, you select November 18th as the expiration date for the collar. And you go ahead and sell to open 10 call contracts having $115 strike. Now, why 10 contracts? Because you own 1,000 shares. Every contract controls 100 shares of stock. At the same time, you buy to open 10 put contracts having a strike of 105. And as I'll show you, the trade will cost approximately 68 cents a share or $68 per contract times 10, $680 to protect 1,000 shares of stock. Here's the options chain from within Think or Swim, the platform that I'm using. Everything should be self-explanatory. On August 16th, while the stock was still trading between 109 and 110, I selected the expiration date of November 18th, 2016, and I sold to open 10 call contracts having a strike of 115. I collected a total premium of $2,470. At the same time, I bought 10 put contracts with a strike of 105 and paid a total of $3,150, most of which was, of course, covered by the collected premium. I only had to pay $680 out of pocket to implement this collar strategy. Very well. Now let's examine the profit loss graph associated with the collar strategy that we just finished implementing. Remember, we own 1,000 shares of stock. We got in at the low price of 100 or 101 roughly. It is currently trading at $110 a share, so it's had quite the run up. Evidently, we're looking to protect our gains. To do so, we're going to sell 10 call contracts with a strike of $115. We're going to collect a premium of $2,470. Don't get too excited because you're going to spend it all on 10 put contracts with a strike of 105. Those are going to cost you a total of $3,150. So out of pocket, you're going to pay $680 to implement this strategy. Now you're protected because no matter how bad a hit Apple might suffer, your minimum profit is guaranteed to be $43.20. Even if Apple were to fall to $50, $30, it doesn't matter. You're guaranteed a profit of $4,320. Conversely, should Apple rally to new highs, your maximum profit will be $14,320.